Welcome back to the course. In this video, we're going to be talking about trading processes. So one of the major parts of our trading plan, when we've got those risk management and targets guidelines in place, is to actually look at the trading processes that we're going to be following. So when I say trading processes, I'm referring to this step-by-step guide to your actual technical approach. This includes three major areas: trade execution criteria, trade management processes, and trade exit criteria as well. So this video, we're going to talk through each of these. I'm going to show some examples as well of what kind of things you need to be marking down in your trading plan to actually go forward successfully and with a solid plan, solid foundation base in place. So step one then, trade execution criteria. What we mean here is actually looking at what do you need to see before you consider entering a trade, right? Trade execution is actually entering a trade, executing a position. So what is your criteria to actually do this? What do you need to see before you consider entering a trade? Are we looking for 1, 2, 3 or more confluences or reasons to buy or sell? Trade execution criteria needs to include things like market flow and candlesticks, the things we've spoken about so far. So what market flow aspects are you going to identify? What order are you going to identify them and carry them out in? And then how are you going to actually confirm an entry using candlestick patterns that we've spoken about in the course? So for our trade execution criteria, we really want to write out our step-by-step process to actual, trading, technical trading, and what we need to see, what we need to look for before we can actually go ahead and enter a position. So an example then of your trade execution criteria might be, step 1, I'm going to focus on a top-down approach. I'm going to carry out some top-down analysis from the high time frames to the low time frames to view the market, view all market flow aspects, and then find candlesticks to actually enter the trade. So step 2, my real first step of technical analysis is going to be identifying the market structure, identifying which way the market is running overall. When I've done this, I'm going to plot my key levels, I'm going to plot my supply and demand zones. Then I'll wait for price to react into one of these zones, a key level, support and resistance key level, or a supply and demand zone. And then I will buy or sell in line with the trend and in line with my analysis using candlestick confirmation. So an engulfing and inside bar, one of these things that we've spoken about so far. So that's an example of your entry criteria, right? What do you need to see? We need to see market structure. We need to identify an entry area using key levels and supply and demand. We want to wait for price to react, give it time, give it patience, and then buy or sell in line with the market using candlestick confirmation and only when we have candlestick confirmation, okay? So the first step really is going to be writing down what it takes to actually find and execute a trade. So from there, we'll begin looking at the trade management process. We've spoken about trade execution, looked at what we need to see to actually enter a trade, to execute a trade. And when we've done that, we need to look at how we're actually going to manage the trade once we're in it, okay? When you enter a trade, how will you manage it? When are you going to move your stop loss orders to entry? When are you going to move them into profits? When are you going to take partial profits throughout the trade, right? Are you going to take specific profits when you hit key levels? Are you going to take full profits early? Things like this, okay? Trade management process needs to cover every step of the way from the entry through actually managing your trade towards targets. So we'll look at criteria for actually exiting a trade early if it goes south. We also need to think about the discipline and the importance of trying to hold our trades out all the way to targets to fit our risk-reward strategy. So some examples there of the trade management processes. When my trade is X amount of pips into profit, I'll move my stop loss to entry, removing the risk from the trade. Another idea is when my trade surpasses 2 structure points, right, as we spoke about in previous videos, I'll actually then move my stop loss into profit. So the worst case scenario is still going to close my trade out with money made. When price reaches a preset key level, so a level that we've plotted from the start, from that first part, when we are identifying these key levels, these zones, targets, and entries, when price reaches one of these key levels, I will take X percentage of my profits. So for example, If we have a overall target 200 pips away, but there's a key level 100 pips away, we could actually then look to take 50% of our profits when we hit that 100 pip key level. What this means is if we break the level and continue, brilliant, we'll maximize profits and hit our full target. But if we actually tap that level and reverse, rather than getting burned and losing out on all of the profits that we made so far on this trade, we'll have already taken half of our profits off. So when this trade runs all the way to hit stop loss in profit or break even, we've still secured a profit and we can still be happy with that trade. So another example is if structure changes, I will actually then look to remove the risk from the move by putting my stop loss to entry. So let's say your trade is running nicely. You've taken out 2 structure points and target is on the way. But then we actually form a sharp reversal kind of movement and retake one of those structure points. Now, what this will show is a large buildup in momentum the way that we don't want it to be going, right? If our trade is ran, let's say we are short and our trade is ran 2 structure points low. If we then go take out one of those structure points back to the upside, that will then tell us that structure's changed and bullish momentum has re-entered the market stronger than bearish momentum. So in a situation like this, will we then move the stop loss to entry to make sure that if the trade goes against us and it goes all the way back to the entry point, we are out risk-free and we're not going to take a loss. Another thing worth mentioning inside of your trading plan is hold undoubtedly unless the trade criteria is broken. Okay, we've spoken about the importance of risk reward, the importance of actually holding out for those large risk reward movements. So it's important to include in your plan how crucial it is to actually hold your trade undoubtedly, unless of course your trade criteria is broken and your trade becomes dangerous. So these are all examples of trade management ideas that you could put inside of your plan. Things to consider. Okay, when are you going to move your stop loss to entry? When will you then progress to move your stop loss into profit? When will you begin to take portions of profit at key levels, at logical areas? When will you actually look to risk-free the movement based on structural changes or when a trade looks like it's going to move against you? And then will you actually hold your trade all the way to your targets and follow your risk-reward strategy, right? Do you have the discipline to do that? So when we have our entries and our trade management down, we need to actually look at trade exit criteria and the safe ways, the logical ways to actually get out of trades, right? Be it at a profit or a loss. So some ideas here then, when your trade is in profit, how are you actually going to manage profit taking, right? Taking portions, taking full profits. How are you going to manage a trade that turns around on you? Will you exit early? Or will you focus on those trade management things that we just spoke about and keep your stop loss to, to break even, to cut risk? Are you going to actually make early trade exits if the trade begins to go south and move against you to secure profits before things go bad? And on the contrary, when trades are actually losing, how are you going to exit those trades, right? How are you going to take smaller losses and avoid breaking your risk management strategy? So some examples here, then I will select more than one take profit level so that I can secure profits on the way down to my final target. This means if a trade is running, you've got a big target in place, you can actually slowly take profits off as we surpass levels. What this means is, as mentioned before, if the trade reverses on you, you've still had a happy, successful trade. I will aim to hold trades to all of my preset take profit levels. Now, this is basically the same again. We preset those take profit levels. We preset, right, when we hit this level, we're going to take half profits. When we hit this next level, we'll take the rest of our profits. Preset these levels and then stick to them, right? Unless there are criteria changes, we will aim to hold all of our trades to all of our preset take profit levels. And that is going to be a big part of our exit strategy. Now, another big part of our exit strategy is being logical and being able to accept market changes, right? And that means early exits. So while we do need to consider early exits, something you may think is, I will only make an early exit if the trade criteria is broken. This means then if structure gives way and things begin to turn against you, you're there ready to make a logical early exit. But if things don't change, things don't go south, you're actually going to have the patience to hold the move all the way out to those original preset targets. An example is if the 4-hour chart closes with conflicting price action to what I'm trying to trade, we could actually look to early exit. Okay, so let's say we are 100 pips into a movement to the downside, and then we have a bullish movement that goes up 60 pips and takes out some structure highs, okay, and then closes up there with, let's say, a bullish pin bar or a bullish inside bar. If the 4-hour chart closes like that, that really invalidates the price action that we've seen previously, okay? And at this point, we may then look to early exit the trade, take what profits we do have left on the table to avoid a loss, right? Now, whether or not you're going to be an early exit trader like this, or someone who just sets their take profit to risk, that sets their stop loss to risk-free the movement at break even, is going to vary, okay? I do recommend trying to hold the trade out as long as you can. So if a trade goes south, it can actually be more logical to move your stop loss to break even. The reason being that there's always a chance the market's going to turn around and continue going in your direction and fulfill targets. If you are a panicked trader and you're consistently early exiting trades, you're never going to reach your risk reward levels, right? So you need to actually put this in your plan to think logically and make sure that you only early exit if real trade criteria is broken and you're given a real reason to actually escape the trade. So very important aspect then, the final one I'm going to mention here is stop losses, okay? And with your exit criteria, it refers to stop losses as well. It's important then, never move your stop loss further away from price or never remove your stop loss from any trade. We've spoken about risk reward. We know that it's okay to take losses. A loss is fine as long as we outweigh it with a winner. Now, losses are pre-planned, okay? We pre-plan that percentage that we can lose on a trade. If we have that pre-planned and then we begin moving stop losses further away or removing stop losses entirely, this is when risk grows, okay? There is nothing saying that the market's going to turn around. So let's say your stop loss is going to get hit at minus 50 pips and you remove your stop loss thinking that it's just going to spike through and come back. Next thing you know, trade is running minus 200 pips and you have a huge catastrophic loss on the go. That is down to you removing your stop loss, and that is down to you breaking your exit strategy. So it's important in your plan then that you mark down a consistently followed exit strategy for winning and for losing trades, using some of these examples and some of these pointers that we've mentioned here as well. So to recap then, trading processes, we're looking for a step-by-step guide to our technical approach, right? That includes trade execution, the actual criteria it takes to enter a position, trade management, the processes that we're going to follow when we're in a position to make sure we cut risk and maximize our profitability using stop loss and take profit utilization. And then trade exits as well, okay? What criteria are we going to follow to actually get out of trades when they go south? What criteria are we going to follow to get out of losing trades without taking significant hits and without breaking our risk management strategy? And what criteria are we going to follow when a trade is winning to take off portions of profit and secure profits as we go, right? So that's all for this video. A nice important part of your trading strategy is these trading processes. Definitely need to be marked down in your plan. Hopefully now you've got some good ideas of what kind of things you need to include. And of course, as we reach the end of this chapter, we will then be talking and showing some real examples or a real example of a trading plan with everything included. Okay, so make some notes, run back through, write down some notes, some ideas, things that you need to include, trade management processes, your entry and exit criteria. And without further ado, I will see you over in the next video.